Hey guys, we're back with another North American trucking and supply chain market update for June 2025. So what have we seen? The trucking market remains generally oversupplied with carrier capacity exceeding demand, keeping spot rates relatively competitive. There is some seasonal tightness in the reefer and flatbed markets because of produce and construction activity. The 25% tariffs that did take place on Canadian imports has generally stabilized after some initial disruptions, but cross-border flows are still adjusting. Freight demand is steady. However, there is a market rebalance that will probably take place early 2026 as carriers continue to exit the marketplace. Shippers can capitalize right now on favorable rates, but should plan strategically for regional capacity constraints in certain areas. Let's talk about the Canadian domestic trucking market, specifically the dry van segment. So what we've noticed in June is roughly a 3% decline in rate per miles across the board. What has that been driven by? Well, normalized inventories from a lot of customers and manufacturers, reduced rail congestion at hubs in Toronto and Vancouver, load to truck ratios have slightly dipped, reflecting a softer demand post holidays, Victoria Day, Memorial Day, and LTL dry van rates have relatively been stable. The one thing shippers should monitor is just the urban hubs. As summer retail demand grows, Toronto, Vancouver, Montreal area tend to have a little bit of capacity constraints, but overall, we have seen a reduction in both pricing and an increase in capacity. Now in the reefer space, although a little bit more expensive than dry van, we have also seen a decrease roughly 3% month over month from May to June. Ontario and Quebec produce season has peaked. Produce tariff surges have somewhat faded. Load to truck ratios also down. Overall, the reefer space is very well mimicking the dry van space within Canada. And I think the only thing shippers should do is focus on early booking to secure capacity. In the flatbed space, rates have remained very stable despite robust construction activity in Alberta and British Columbia. Load to truck ratios somewhat flat. Shippers should leverage competitive rates while planning for some potential tightness in Q3 as construction peaks. So what are some key takeaways for a lot of you shippers focused on the Canadian domestic marketplace? First things first, rail disruptions have generally subsided in June and present a viable option for a lot of you shippers focused on moving your goods across Canada. It's a good cost-effective option that I think a lot of people should consider. Secondly, over the road has also eased. Capacity has eased, rates have eased. I think it's a great idea for a lot of you to lock in rates now to avoid any potential increases in the latter half of 2025 entering into 2026.